You've probably heard that stacking trades is gambling. What if I told you that stacking trade is not gambling when done the right way? Imagine this. Instead of placing one trade and hoping, you stack your position in planned layers only when your setup confirms it. That's the core idea. Today, I am sharing the exact simple stacking strategy I used to help double my trading profit without getting lost in complication or overtrading. This isn't financial advice, but a clear framework you can test and refine. If that sounds interesting, let's break it down step by step. What's stacking? Stacking in forex trading is a position management technique where a trader adds multiple trades in the same direction as the market moves in their favor. Instead of opening just one trade, you stack additional entries to maximize profit from a strong trend. Now the question is, why do traders stack? Number one, to maximize trend. When the market is trending strongly, stacking allows you to extract more profit from one move and not missing opportunities. Secondly, to reduce initial risks. Instead of going all in at once, you start small, add only when the market confirms your direction. Now we have key rules why stacking trades. Stacking is not random adding of trades. You should only stack when market structure supports it. Now the market structure we are talking about here is higher highs or lower lows. You understand? Then you are already in profit. When you are in profit, you tend to add more to your open trades. You have a clear strategy. It could be breakouts, it could be pullback, it could be other blocks. Now, what are the different types of stacking we have? We have aggressive stacking, that is the gambler style of stacking, and conservative stacking. Now, when we talk about aggressive stacking, we talk about adding trades quickly. You see a trader opening 2, 3, 4, 5 positions or even up to 10 positions all at once. And most times, they don't apply proper risk management doing that. Those are traders that want to flip their $100 to $1,000 or their $50 to $5,000 in a month, in a week, as the case may be. So high profit potential and also higher risks. Same way it is going to give you a higher profit potential. If the trade goes the wrong way, your risks are high. And most times, traders that use the aggressive stacking are glued to their screen. Okay, you are always in front of your screen looking at the market. What is the market going to do next? While conservative stacking, you only add to your position only after confirmation. Okay, only after confirmation, that is when you add. Now it gives you lower risks but more controlled growth. All right. Now, when stacking, you should not avoid risk management, because as long as trading is concerned, risk management is key to profitability. Now, what does it say here? It says that if you stack carelessly, you can blow your account fast. But proper stacking means move stop loss to break even, protect earlier trades, don't over leverage. Whenever you are stacking, always apply proper risk management. Always ask yourself, what portion of my account am I willing to risk? If 1% is okay, good. If 0.5 is okay, good. If 2% is what you want to go for, still fine. But understand what risk is whenever you want to stack. Now, pro tips. Stacking works best when combined with trending, market structure, and patience. It does not work in choppy markets or emotional trading. I am going to take you to my chart and show you one setup I took in the past, how I was able to stack multiple entries and how I managed that trade till it got to my profit target. Let's go. Now, this is a chart on GBP USD, and this is one of the trades I took in the past. I want to show you how I was able to add multiple entries to one setup I saw. Okay, first things first, I was able to identify that price is trending to the downside. Price has started giving us break of structures to the downside. Okay, now what happened? Just as I always say, I want to see all my confluences in play before I go in for a trade, either buy or sell, right? Now looking at this setup right here, this was the first setup I took. I first of all spotted that we had a clear break of structure to the downside. I had to position myself here because I saw an order block. Then secondly, there was an imbalance candle seated very close to my order block. Thirdly, I had liquidity present on this particular zone right here. Okay, now I had to take out my Fibonacci tool to check if that area I was using as my sell zone was expensive enough for me to sell. And just as I used to say, I love to go for the 78% retracement zone. So when I see price inside this zone, I want to start looking for selling opportunities if price is bearish, or buying opportunities if the market is breaking structures to the upside. Now you can see that from one setup, I was able to mark all my confluences: break of structure, order block, liquidity, imbalance, and my premium zone. Okay, that was how I was able to catch this A plus setup. And as you can see, my profit target was at the point of reversal. Now something happened. I added more positions to this particular trade. Why did I do that? I would have simply added 5 positions at this particular zone, just as all these traders that want to flip their money do. Okay, but no, because I am more of a conservative trader than an aggressive trader, or should I say, I love to apply proper risk management when I trade. I waited for price to do what? Start breaking structure. This is what I call internal break of structures to the downside. When I started to spot this break of structures, let me mark it out. If you look right here, you can see that after I entered with that first entry, we had a clear break of structure here. Okay, that was an internal break of structure. And what happened? I was expecting the market to come back into this particular zone here because we had an imbalance candle here, but as you can see, price didn't do that. Rather, it gave us a new break of structure, and right here we had another break of structure right here. Now immediately I spotted this break of structure, I did not just enter blindly. I wanted to see if the confluences I saw here initially also applied here before I decided to jump into this particular trade. Okay, and what did I see? I saw an internal break of structure, same as I saw a break of structure here. I saw an order block here, same thing here. I saw an imbalance candle here. I spotted liquidity seated right here, and after taking out my Fibonacci to look at if price is expensive enough for me to start selling, and you can see price pushed into our 78% retracement zone. It was here that I had to place a pending order, and price mitigated it. And where was my take profit? Still where my first initial TP was, still at the point of reversal. That was where I placed my second take profit. Okay, now after I entered this market, something happened again. You can see we had another break of structure here. Now you can see that I was able to take multiple positions wisely, not as a gambler, but as a trader who had an edge over this market. Okay, now immediately I saw this break of structure, I spotted this tiny blue candle right here. I spotted imbalance seated there. What did I do? After the break of structure, order block, imbalance, then I had to mark out my Fibonacci, and you can see price reacted into our 78% retracement zone, and that was how I was able to catch that trade. Now you can see that I did not just enter these trades blindly. Same confluences I saw here that made me enter this trade, I also saw it here, and I also saw it here. That is how to stack the right way. So guys, I hope this particular video is going to help you on your flipping or stacking journey. Till then, make sure to hit the subscribe button, turn up post notification so that you get notified whenever I drop contents like this. See you on my subsequent videos. Stay blessed.